In this video, I'm going to show you how to use edgeful as an options trader. So I'm going to quickly run you through top to bottom how everything is kind of laid out, what you can use, what you want to be looking at, and then I'm going to go through some of these price action reports and tell you what would be most beneficial to you. So very high level, for options traders, you want to be in this stocks section. You can also go to futures if you like to look at ES or NQ. That will be in the futures section. This nav bar right here is going to be your steering wheel for the site. So price action report type is the one that we're in right now. Then when you click on the reports, this is the drop down of all the reports that we have currently. We're adding more every week. Then we have the tickers, and we have every stock and ETF you can imagine. So whether you trade Tesla, Nvidia, whatever, it doesn't matter. You'll have it in here. Then the date range. So these are all defaulted shortcuts to trailing periods. So if you click 2 years, that's going to default you back to the trailing 2 years. If you click 1 year, that's going to be the trailing 1 year. You can also pick a custom time frame, so you can select actually the start and end dates, but we're going to stick to the 1 year for now. So we always have a visual representation of the results, a table representation. Most of the reports, and eventually all of them, will have an explainer graph. So in this case, showing you what a gap up is. Then you can kind of go through to see, okay, what's a gap filled? A gap up filled is here, gap up not filled is that. If you need some more details on what gaps are, you can click on this button right here. This will pop up this window. The trading view indicators we will have them for every report. So all you have to do is click on this button and then submit your trading view username, which will be you go open up your trading view, click on this thing here. This is your trading view username. So send us that when you open up this button. We have some more text. What does this measure? This is something that you always want to be looking at. If you're not a reader, just read it for the first time when you come onto this report, or any of the reports, honestly, because it tells you exactly what it's measuring and exactly how it's being measured and how you can use it too. Then we have a video that will walk you through exactly what this is and how it works. And that is pretty much it in terms of the layout. And finally, if you see these, I just missed that, but if you see these bubbles here, that is a variant of this report. So we have the gap fill, the standard, we have gap fill by size, by weekday, etc. So now I'm going to go into some of the reports that are helpful. I'm personally an options trader, so this is stuff that I use myself. So let's start off with the gap fill, something that I really like, something that I use all the time. And here I'm just going to go into what it is. So a gap fill is, let's say Monday opens. I'll actually just show you right here. So Monday closes at $100. Let's pretend this is 100 here. Tuesday opens at 105. That's a gap up. So overnight, price moved up. That's a $5 gap up. Then a gap fill is when price comes back down to touch the previous day's closing price. So you can always think about a gap fill as touching the previous day's closing price. The same thing goes for a gap down. So let's say price closes here at $100, opens the following day at $95. A gap fill is when price comes back up to touch the previous day's closing price on that day. So it has to touch on Tuesday. If it does not touch the previous day's closing price that day, that is a gap not filled, and we don't measure gaps multiple days later. So keep in mind, it either fills or it doesn't in this day. So what you can see here is that 62% of gaps up in the last year have filled, and 59% of gaps down have filled. So there is a slight bias towards the gap filling in either direction. So as an options trader, the way that you use this is you say, now I can have a bias targeting that gap fill. So if there's a gap down, you have a bullish bias targeting that gap fill. If there's a gap up, you can have a bearish bias targeting that gap fill. So now we'll switch to the by size report here. And this one's actually very interesting because I'm actually going to switch to the percentages here, to the dollars here, just because it's easier to conceptualize. Right now we have filters for gaps less than $1. And what you can see is that 80% of gaps up less than $1 have filled in the last year, and 91% of the gaps down in the last year have filled. So again, as a reminder, gaps up filling means price comes down, Gaps down filling means price goes up. So you always measure to the previous day's closing price. Now, smaller gaps tend to fill. However, larger gaps between $3 and $5, these are a little bit bigger for SPY, tend not to fill. So you don't want to target that gap fill on SPY if they're between $3 and $5, because historically they're not going to come back to fill that gap. So smaller gaps, you want to expect the gap fill, larger gaps, you don't. Then here's a really interesting one, is the bi-weekday variant. So let's just start off on Mondays here. Very, very interesting stat. For every time in the last year that Mondays have opened below Friday's close, 95% of those times, Monday's price has come up to touch Friday's close. So you can see gap down filled. If this was Friday's close, this is Monday's open. 95% of the time in the last year, price has come up to touch Friday's closing price. So gaps down on Mondays are very bullish as of right now. Go throughout the week. Again, use the same principles that I just explained. Carry this throughout the week. In terms of, like for example, you see here, Fridays tend to fill that gap very often. So in either direction, 65% of gaps up will fill, 71% of gaps down will fill. So Friday has a very high fill rate. Again, if you're an options trader, you want to target these areas. Now, I'm going to switch to the buy close variant here. And what this one measures is only gaps that have already filled. So here's a really good explainer chart. The gaps up that have filled, how have they closed on the day? Above the previous day's closing price, which would be green, or below, which would be red. So you can see that 58% of the gaps up that have filled in last year have bounced back out into being green. So this has happened 58% of the time, rather than continuing down. So this would be the continuing down. This would be this area here. So gap up that filled, closed red, which would be this situation. Gap up filled that closed green, which would be here. So the way that you want to use this is to say, I don't want to hold runners very far below this gap fill line because I should be expecting a bounce, because almost 60% of the time, price is going to bounce back up by the end of the day and close green. So that's the gap fill report that I'll cover. I'm quickly going to touch on a few other ones. So this is the green and red days by weekday. There isn't anything very specifically actionable here, but this just helps you again with the daily bias. So you can see that 67% of Mondays in the last year have closed green. So having a daily bias to say, okay, Mondays seem to be very bullish, the gaps down are very bullish, the prices actually tend to close bullish on these days. So I don't want to be too bearish on these days. So as a reminder, this report just shows you how often a certain weekday will close red or green. And always, by the way, with stocks, red or green is always determined whether we're above or below the previous day's closing price. So if this is the previous day's closing price right here, above that is a green day, below that is a red day. Just keep that in mind. That's how green and red days work. It's not by candle color, it's by whether we're above or below the previous day's close. So, let's see. I'm just going to touch on a few of the higher level ones that I think would be most important, and then you can obviously go in here and review these yourself too. So, this is actually a very interesting one for options buyers, and I'm going to talk about options selling in a minute too. So, what this report shows you is what is the average range within a certain time period. So from 9:30 here to 10:30, what is the average range? And what you can see is the average range on SPY in the last year, within the first hour of trading, is roughly $2. So as an options trader, personally for me, I like to focus on that time period because that's what has the most volatility. And what you don't want to be doing, and the way that you use this report, is to say, I'm not going to set my profit targets, if I only trade that first hour, $3 away. Because historically, you're only going to get a $2 move. So you don't want to put your profit targets at $3 or $4 if you only like to trade that first hour, because that only happens later into the day. These bigger moves happen later into the day. So you want to make sure that you're taking your profits on what the opportunities normally are. Meaning like take your profits at $1, $1.50, and then $2, and you can leave runners, of course, because you always want to be able to capture like the rest of the move. But you don't want to be setting your entire profit target at $3 or $4 away, because historically it's going to reverse and probably consolidate within a certain smaller range. So that's for options buying. And for options selling, I'm going to move this. So personally for me, I like to sell vertical credit spreads. And the reason this report was actually built was so I can understand what is my expected range after a certain time. So I like to start to look for an entry around 1 p.m. And the reason this report was built was because I wanted to see, okay, what's the average range that I could expect for the rest of the day, so I could sell the strikes outside of that, so either above or below. So let's say price is sitting at $100 here. Let me see if I could find an example, actually. I'll switch to a 5-minute, and then I'm going to mark down the 1 o'clock right here. So let's say I like to look for an entry right here, and this is my line right here. This is where I'm looking. So what this says is you can expect a $2.70 range from 1 p.m. to close. So what that means is if I'm looking for strikes to sell, I am looking to sell, let's just say this for example. I'm just going to make this a little bit smaller. So I want to sell strikes outside of 270. So this is a $2.70 range to the upside. So assuming this continues up, I want to sell the strikes up here. So I'm going to mark a line right here. And then I'm going to do $2.70 to the downside here. And then, so now this is the range you can expect. And then now I'm going to put this here. And now what I like to do is sell the strikes from here up or from here down, depending on the trend of the day. So not to get into the details there, but this report really helps me understand what is the expected range for the day. How much meat is there on the bone? So if you're an options seller, not to get into the details right now, but you want price, in this case, I would want price to stay within this range, which is obviously very likely, and I would capture the premium here after it's decayed. All right, and you can also look at this report by weekday too. So another one that I really like is the previous day's range. So what this report measures is for every time the previous day's high is broken, we close green 77% of the time. For every time the previous day's low gets broken, we close red 75% of the time. So let me do this quick. Let me wipe all these drawings off. Let me show you what that means. So here, we're going to mark yesterday's high. And you can see that we broke, obviously, yesterday's high right here. I should probably make this bigger so you can see this. So you can see that we obviously broke yesterday's high and we closed green on the day. Of course, we closed at high of day. So there is a very strong likelihood that when we break yesterday's high, we close green. That also goes for yesterday's low. If price had come down and broke yesterday's low, then it would be very likely that we close red on the day. So these levels are very key to look at. So in this case, the way to use this as an options buyer is to say, once we break that level, I should have a bullish outlook because historically price will close green. The other way to use this is to say, once we do break, I'm just going to delete that. Same thing for options selling here. Once we break this level, I'm just going to show you the line here. This is actually the red-green line, so this would be, I'm going to make that yellow. So price, if it closed below this yellow line, would be red, above the yellow line is green. So this is the line that would show the red-green, which is also the gap fill. So if price breaks this level here, yesterday's high, what you want to do is, or what you can do, is sell credit spreads down in this area. Because now you have let's look at it again. You have a 77% chance that price will close above this yellow line. So now you have a very high win rate. So you can sell strikes down here, put spreads down here. So that is how you use this specific report. The other one that I want to show you here, this is the last one that I'll show you, is how often do we touch the previous week's range, so the previous week's high and low. You can see that in the last year, we have touched the previous week's high 66 or almost 67% of the time. We have touched the previous week's low 29% of the time. But most importantly, we have touched both the previous week's high and the low less than 8% of the time. So what that means is once we touch one, once we go up to touch the previous week's high, we should not expect it to come back down to touch the previous week's low. So that means that you don't want to target, if you're, let's say we touched the previous week's high, you don't want to be very bearish and target the other side of that range because you're historically not going to get there. Or you can sell spreads or sell options below the previous week's low because historically it's not going to get there. So overall, very quick overview of the price action report type for options trading. If you have any questions ever, click this support button and let us know what your questions are. I'm happy to help in any way. I hope this video was helpful. We'll definitely have more reports built out that will be more helpful to options traders. Thank you very much for watching, and make sure to watch the volume video that I'm about to make, which will probably be in this playlist.